These videos and accompanying PDF package have been prepared by Patricia Malia. Personal use of these items is welcome. However, any use of these videos and package for commercial or monetary gain is not permitted without express consent from the author.
Financial statements are prepared so that the people that are looking at them can use them to make decisions. The decisions that they make usually have to do with three aspects of the company: its liquidity, its solvency, and/or its profitability. The liquidity of a company has to do with its ability to pay short-term debts. If a company cannot pay its suppliers, then the suppliers are not going to supply them with any more inventory. If a company cannot get inventory, then they are not able to function with their operations. So it is extremely important to have liquidity and ability to pay short-term debt. Solvency is the ability of a company to pay its long-term debts. Long-term debts are any debts that need to be paid back in more than a year's time. These debts are usually much larger than our short-term debts because these are what we use to purchase our equipment or our buildings. So they tend to be much larger because the items we are purchasing by using them are a lot larger too. It is these debt holders who are usually the ones who can place our company into bankruptcy if we're not able to pay them back what we owe. In order for our shareholders to get dividends and for our short-term and long-term debt holders to get paid, we need to make a profit. If we cannot make a profit, then absolutely everything else in our company is going to have problems. The first two liquidity ratios we're going to calculate are working capital and current ratio. Working capital is current assets minus current liabilities. What we're looking for here is that we have more current assets than we do current liabilities. Current assets are those assets that are going to disappear or turn into cash within a year, and current liabilities need to be paid within 1 year. Looking at XYZ company, we can see our current assets are $417,500 and our current liabilities are $168,000. Therefore, $417,500 minus $168,000 gives us a positive working capital of $249,500. We have more current assets than current liabilities. We should be able to pay off our short-term debts. A better calculation, though, is to take these two numbers instead of subtracting from each other to have current assets over current liabilities. What is our ratio of current assets to current liabilities? Here the ratio is 2.49 times. We have more than twice as many current assets as current liabilities. Although no number is perfect for any company in any industry, I like to look for the number 2. I like at least twice as many current assets or current liabilities. That is because it can take a while to sell our inventory, which is a current asset, in order to pay off some payables, which are a current liability. If that is the case, then this company has plenty of liquidity. Next, let's look at solvency. Solvency, the ability to pay off long-term debts. As you can see here, I have my total liabilities over my total assets. This is our debt to total asset ratio, meaning that we have 60% debt to total asset. Let's look at these numbers on our balance sheet. Here are our total liabilities. Here are our total assets. Our debt is 60% of the assets. In other words, we purchased this $979,500 using either debt or equity. If we used 60% to purchase using debt, then we have used more debt than equity to purchase these assets. Our bank is at a higher risk if we don't make money and can't pay them off than our shareholders are. They have more money invested in the company than the shareholders, who have only $391,500. The more that the banks have invested in the company than the shareholders have invested in the company, the more nervous the banks are going to get. Therefore, it is not healthy to have a debt-to-asset ratio that goes much higher than 60%.
Although each company in each situation and each industry needs to be looked at separately.
The higher the number, the more nervous your bankers are going to be. Let's look at the profitability of XYZ using earnings per share and price earnings ratio in the next video.